Hi, I'm Lou Ann Fulmer here with Andrew McNair. And it's impossible to predict whether the markets are going to be up or down or sideways when you retire. That's one of the big unknowns that we're going to face in retirement. So let's talk about that, Andrew, how you build a plan for good markets, bad markets, and everything in between.
Sure. They don't teach you this in college. At the universities, I found out the hard way. Luckily, I started entering at a financial firm when I was 14. And so by the time I was 18, I started seeing my own clients. And
Wow.
when I was told, my mother said, "You got to go to college. You have these scholarships. You need to take advantage of it." I listened to my mother and I went to school. And when I got there, I was shocked. They were teaching these college freshmen in finance that you should put a little bit of your client's money in bonds,
Hmm.
cold water. You
Okay.
should put some of your client's money in hot water. And do you know what happens, Luann, when you mix hot water and cold water together?
Yeah, lukewarm.
Lukewarm.
Yeah.
And they said, this is how you slow down the portfolio so it doesn't drive over a cliff. And I
Huh.
thought to myself, no, that's how you don't get fired, because lukewarm results make sure that you can charge fees on your clients during good
Oh.
times and bad times, and you don't get fired. And I found out that success leaves clues. If you look at major endowments, you look at pension funds, you look at family offices where you have to have a minimum net worth of 50 or $100 million, they don't manage money that way. So here's again the big block of the public is managing their money with this mixture of stocks and bonds, but that's not how wealthy people manage their money. So what I did is I took the concept that endowments like the Yale endowment manages their money, and I shrunk it. Instead of managing $47 billion, to shrink it to someone that has $2 million. And we explain this secret sauce called the Fiscal House. And people say, why would you share your Coke formula? Well, it takes so much work that I doubt people are going to do it anyway. But we need to make sure that you have foundational assets. Foundational assets are anything that is tied to interest rates. So when interest rates go up, you make more money. Think MYGAs, checking accounts, savings accounts, money markets, government bonds like I bonds, and things like life insurance, anything that is foundational that cannot go anywhere. It's bedrock. It's typically a safer investment. Then we need to have roof accounts. Now, roof accounts are great when it's sunny outside. But when you have a hurricane, which we know way too much about here on the Gulf Coast, you're going to start losing shingles. We need to have market related accounts like stocks and ETFs and bonds and mutual funds. Why? Because when the market's doing well in those sunny days, you want to enjoy the springs and summers. But where people sadly miss it is in the wall sections. Most people do not have wall accounts that are insulated from market risk. And examples of these, which is not available to everyone, but things like private equity, non-publicly traded companies, so private equity, things like hedge funds, things like index CDs and index annuities and puts and options, things that zig when the market zags. Real estate is a great example of a wall account. So when you have foundational accounts and wall accounts and roof accounts, you're not worried about where the market's headed. Why? Because you are properly, insulated with wall
Mhm.
accounts. You're not worried about interest rates because you have foundational accounts. And when you're in that position of strength, that's when you're ready for retirement.
Very, very good. So that's the way you guys help people manage market risk because we certainly can't control the market, right?
Exactly. And again, we need to be able to actually not only be at the mercy of the market, we want to be able to take advantage of the market. And so here's how we helped many of our clients in 2020 is that when the market dropped over, 30%, what it seemed like overnight, we use that as an opportunity to take money from the foundational accounts and the wall accounts to buy while the market was in a selling mode,
Mhm.
because the market is manic. I mean, if it was a person, it would be on depressant medicine, because constantly it's like this shopkeeper that says everything's for sale, take everything, it's half price. And then some days it's like, nope, we have low inventory, we don't want to sell it to you, everything's overpriced right now. And you have to be in a position, and you have to have an advisor, and you have to have a plan that can change with those economics. If not, you're stuck with the college freshman that finally graduated from finance and has put your money in stocks and bonds only, and you just have this melting pot of lukewarm results.
And then the other thing is, having this type of a plan helps you avoid making those emotional decisions that so many people make when things are rocky in the economy, right?
Absolutely. Many times I've thought about putting a lounge chair in my conference room, and I think it would go over really well because we would point to it and we'd say, "Is it time to sit on the couch?" Because so many times we get so panicked ourselves because we watch so much news, and that's how we like to end our days. We like to say, "How much blood and breaking news and world events do we need to take in before we go to sleep for the next 8 hours?" And we do this habit of taking in all of this information. And then when we get up in the morning, we take a cup of coffee and we hear about the market being down another 200 points. And we may be 2 years from retirement, and it's scary. And so that's why we build every client a financial plan. And what I found is a lot of people have statements, they maybe have portfolios, but if you were to hard press them and say, "Show me your financial plan," a financial plan should have an estate plan. It should have a tax strategy. It should have an investment thesis, which I just talked about. It should have long term care, asset protection, just to name a few. Those all should be factored into this blueprint I'm talking about.
Okay, and so the way you can get this is by putting this phone number in your phone. If you haven't done this yet, Andrew, you and I have been doing this radio show for, gosh, about 8 years now. So if you don't have, listen to our listener, if you don't have this number memorized by now, let me give it to you again, 800-848-8768. Put that in your phone, okay? You may call the office of Swan Capital, set up an appointment, get on their calendar. And then also you could text the word SWAN if you prefer just texting. I think we all like to text because it's quick and we're all kind of in that phase of life where we want to just do things quick. Text the word SWAN, 800-848-8768. And always head to their website too. Great information there. See what Andrew's been up to, swan-capital.com. And we're so excited you joined us. This is what your money would say.